All right, hopefully everyone's had enough time to get refills on their coffee and water in between meetings. I think we're gonna dive in and start right now. For those of you that don't know me, I am Ryan Miller. I am a partnerships team here at the Media Lab, and we are gonna go through finance in the time of COVID-19 today. But before we dive into some of the specific implications on the financial sector during this COVID pandemic, we wanted to take you through a couple of larger macro trends that we've identified during this time. So COVID-19, first and foremost, has acted as a trend accelerator, pushing traditional businesses into the digital age. And we're kind of seeing this come to fruition in several ways. One example is car dealerships experimenting with new sales model, having the car come to your house directly for a test drive, and then ultimately, sign and drive away back into your driveway. Online grocery demand is higher than ever before, with 26% of households actually saying that they use an online delivery service for the first time in the month of March. And unsurprisingly, telemedicine has kind of gone through an increase in usage rate. Usually, telemedicine had been reserved for the treatment of chronic conditions, but what we're seeing now is a lot more consumers adapting to this new model in order to get a checkup, whether it be to find out how their allergies may be acting up during this season, or just to differentiate between the common cold and perhaps something a little bit more serious. Another one of the big trends that we've identified, though, is the burgeoning at-home economy. So this climate has kind of bred a new expertise-driven influencer. So that's chefs and barbers and workout instructors. Food Network in the Kitchen has been a great way for those kinds of chefs to stay connected with their ecosystem. That's a great product. Another trend that we've seen is the rise of in-home fitness, unsurprisingly, with gyms kind of shut down across the country. So those connected fitness devices and keeping track of all of your biometrics is more important than ever before. And we have the tools to actually create a great home fitness routine at home. One last really interesting trend that we've seen in terms of the burgeoning at-home economy, Walmart has actually said that there has been a spike in the top sales, but not pant sales. Obviously, as more and more of us sit on video calls like these all days, we're only seeing the top halves of ourselves. Unsurprisingly, the shift in consumer behavior has disrupted the media industry, with event cancellations wreaking havoc on production and scheduling. Media companies are all moving quickly to make sure that their content is deliverable digitally and through online delivery methods. One really interesting call out is that compared to last year, streaming services are nearly double to where they were in terms of viewership at this time last year. And an impossible to ignore theme is the economic downturn, which we'll ultimately be diving in a little bit further into this presentation. Despite the $2 trillion coronavirus stimulus package the government passed, it seems inevitable that we're going to be facing some sort of economical downturn as a result of a prolonged recovery period. And lastly, and most importantly, what you do matters. Nearly 2/3 of consumers believe that a brand's response in regards to the crisis is going to have a huge impact on their likelihood of purchasing it in the future. This is a really interesting site. It's called didtheyhelp.com. And basically, it's tracking how brands are responding to this current pandemic. And basically, it's chronicling whether they're laying off workers, what discounts they're applying back to the consumers, just so there's a running tab of what everyone is and is not doing. So I'm just going to pause there real quick. And I just want to remind everyone that if you have any questions, I'm going to be pausing in between each section. Just direct any of the questions that you have into the Q&A section, type them in, and then we'll have someone read them out at each of the intervals. So great. We're going to dive a little bit more into the personal financial implications as a result of COVID. And according to Prudential, 54% of Americans actually report not being financially prepared to manage a contagious disease outbreak. And just kind of continue on that trend, according to geo-banking rates, nearly 50% of Americans actually don't have enough emergency savings to get through this crisis. So as we consider the impact at the personal level on finances, we know that a lot of the population is undergoing this huge transformation where they have to be a lot more budget conscious than they were previously used to. And why is that? More and more businesses are shutting their doors or being deemed non-essential. Unemployment has actually skyrocketed in the United States, with 22 million claims being made last month. And Treasury Secretary Steven Mnuchin predicting that unemployment could reach levels as high as 20%. Those levels currently sit at 13% as of checking yesterday or the day before. So we're kind of on trend to see that projection play out. And the St. Louis Fed actually projects that job losses will total 47 million in America as a result of COVID. To help mitigate the effects of unemployment, though, and COVID's impact on the current economic climate, the government's $2 trillion stimulus package, the CARES Act, will include payments right back into the pockets of Americans. So those under that specific tax threshold of $100,000 will, as of yesterday, received a stimulus that puts money directly back into their pockets and hopefully reinvigorate the economy through increased consumer spend. But one important thing that I wanted to note about the distribution of this stimulus money is the role of digital solutions. And before diving into some of the other relief provisions, I just wanted to point out that both Cash App, which is owned by Square, and Venmo, which is owned by PayPal, reached out to the government to be providers of this stimulus. Ultimately, those solutions were foregone as they didn't think that it was the most effective way to put the money back into the pockets of Americans. But interestingly, both PayPal and Intuit were contracted by the government to give out those small business loans as part of the Paycheck Protection Act. So as we think about the role of financial tech startups in the current financial ecosystem, these are just some of the ways they're kind of becoming more mainstream today. An earlier draft of the CARES Act actually included a digital dollar as a means of getting money back to people faster. Ultimately, as we know, that was not decided upon because there is not the requisite infrastructure to support that kind of endeavor at the moment, as well as not the education to make sure that the consumer knows exactly how they could redeem that kind of money. And lastly, just to close the loop quickly on the impact of digital solutions, in a post-COVID world, obviously, intimate interactions are going to be looked down upon, and people are going to be hesitant even to just pass their card across the counter to the person swiping it at the POS terminal. So contactless payment is going to become table stakes in a post-COVID world. Right now, 38% of consumers actually believe contactless payment is a table stakes for when they're signing up for a new card. So just to circle back and go over some of those provisions that are available as part of the CARES Act, top line tax filing has been delayed until July 15th. Unemployment coverage has been extended to 13 weeks and extra funds have been added to the pockets of those people filing. There's been a delay on government-held student loans until September 2020. The government has urged mortgage companies to offer skipped or reduced payments. And finally, the Fed has slashed the interest rates to zero, which has obviously had a massive impact when it comes to the refinancing market. It's not just the government who's taking these protective measures to safeguard the personal finances of millions. Banks are offering a slew of flexible options, such as refunds on overdrafts, loan payment deferral, waived penalties on CD, or suspension of mortgage and home equity lines of credit. So it's not just the government who's really giving back. We're obviously seeing brands and banks step up in a big way to make sure that their consumers are well taken care of. But despite the relief efforts from the government and the private sector, consumers are concerned about their short-term money prospects, as well as the security of their long-term investments, given the volatile nature of the financial landscape. Short-term, have we seen it impact your wallet directly? The spike in the demand for essential items sent consumers into a buying frenzy. 52% of Americans actually bought emergency supplies, with $215 being spent on average for those supplies. Now, what's interesting is that 61% of those people who reported spending on supplies said that it strained their budget. And of the people who were unable to buy emergency supplies, 50% said they did not have the funds to actually do so. So this contextualizes the struggle that many Americans are facing at the moment and puts in perspective how profound an impact this is having on some segments of the population. And while the recently distributed economic stimulus package is supposed to reinvigorate the economy through increased consumer spend, historical precedent actually points to more people taking a savings-based approach with their money. The last time that the government actually doled out a stimulus of this size was during the recession back in 2008 and 2009. And during that time, most people actually opted to withhold those funds and put them into savings. So I think that the historical precedent points towards people doing the same, and we're facing a kind of more uphill battle in terms of economic recovery. And long term, the stock market's volatility has prompted widespread concern about the security of 401ks. Withdrawal penalties, as I alluded to previously, have been waived for fees for accounts $100,000 and under. So there is the availability for people to access their funds without penalty. But most financial advisors are actually recommending that the best way to keep your money safe right now is to leave it where it is. During the 2008 crash, about 5% of those 55 and older dumped all the stock options out of their 401k and then ultimately missed the rebound in 2009 as a result of it, impacting their finances considerably more so than if they had left their money in place. So I'm just going to pause there for a moment and check to make sure there's no questions before diving into some of the impact that we're seeing on business.
So far, no questions.
Great. So to dive in on the impact on business, obviously the most profound impact that we're seeing is at the small business level, as 3/4 of small business that have been reportedly hurt by the COVID-19 pandemic. But there is a few different avenues of relief from the government. As we mentioned previously, the CARES Act, that includes a $350 billion stimulus package that's called the Paycheck Protection Program, that we're seeing multitude of small businesses kind of line up in droves to get access to. At the state level, there's also other stimulus packages being created for small businesses, with notably big states like Pennsylvania, New York, California, and Louisiana developing the most robust comprehensive solutions for small businesses. And just to contextualize how high that demand actually is, on day one of Bank of America's portal opening for small businesses to access those loans, 58,000 small businesses asked for $6 billion worth of loans in just the first 9 hours it was open. And we're seeing that kind of that demand spill over into other lending options as well. Lendio, from their internal application data, has said that the demand for loans has never been higher before, with tens of thousands of applications being submitted every single day, and that number continues to skyrocket. We're also seeing small businesses, as well as people at the personal level, explore new ways of lending as a means of raising capital. This is a really interesting example that we came across called Zerchu. This is a peer-to-peer lending platform that works much like Venmo in a more official format. Basically, up front, you agree to a certain amount of money that you want to loan between someone that you know, and payment terms are agreed upon and ultimately all managed and delivered through this service. One of the more inventive ways that we've seen businesses result to raising capital is through GoFundMe. There's a great example of a pizzeria in Chicago that was actually able to mitigate some of its operating overhead by raising funds on GoFundMe and raised $22,000 to support their claim. So it's not just the government doling out all of the stimulus package and banks kind of stepping in to intercede to help these small businesses. We're seeing a lot of different solutions come to fruition in order to help raise capital. But small businesses are not the only ones under duress at the moment. Larger corporations have not been immune to the COVID impact. Most specifically, the beach companies, booking, entertainment, airlines, cruises, hotels have seen $332 billion, in market cap evaporate. Just some pertinent call outs. OpenTable has seen their decrease in booking 100-fold over this time last year. In Las Vegas, the union that represents some of the hospitality workers thinks that they may have to lay off up to 90% of their workforce, and airlines have delayed or canceled 20 or 50% of the flights that they have. But it's not just beach companies are the only ones experiencing hardship. We're seeing a lot of layoffs and furloughs across multiple sectors, and about 150 publicly traded companies have warned investors of the threat that COVID-19 poses to their long-term financial future success. So JCPenney has announced that it temporarily will furlough the majority of its hourly and corporate employees. Bird has laid off 30% of its workforce. Rover, the pet startup, laid off 40% of its workforce. So there are significant implications beyond just the beach sector that was hit hardest during this time. So those are some of the impacts and solutions available for businesses, big and small. I will pause again to see if there is anything else that has come in.
Nope. Looks like you can keep cruising ahead.
Awesome. So this gets into a little bit more of the actionable takeaways as it pertains to how brands can be thinking about how to position themselves for this new normal that we're going to see. This specifically pertains to some of the things that financial services are doing to better meet the needs of their customers at the moment, as the current climate has left people more unsure as ever as to what to do with their money, leaving many of them to turn to these trusted asset advisors. And we're seeing COVID kind of show the importance of three critical areas for these financial services: the performance of their digital platforms, the communication between advisors and their customers, and lastly, the importance of reliability and trust. So as a result of COVID behavioral changes, consumers' desire for digital banking services has certainly increased, forcing many of the traditional financial institutions to fast track their digital innovation efforts. Platforms like Schwab's Intelligent Portfolios show that their solution can reliably manage downside risk and adjust investment allocations, but are they able to actually monitor those responses in real time and make sure those customers are getting that feedback that is so valuable that you would get in a one-to-one in-person experience? Really interesting call out that according to Deloitte, 38% of consumers actually use UX and user interface as their main determining point for when they're choosing a new online bank. So as we see the rise of these digital platforms and making sure that customers have accessibility to their accounts in multiple facets, there are flaws that are being exposed. The firms that are not already set up to handle digital lending have been placed at a significant disadvantage, creating delays in the impact that which ultimately impacts relationship growth. I think that there is a reasonable explanation for the lag in developing these digitized solutions, though, as in 2019, 65% of people opened their most recent account in person, with only 22% of those account openings happening online or via the mobile application. That number has actually shot down 10% to 55 in 2020, probably as a result of what we're seeing now. But I think long-term in the future, that convenience and accessibility is becoming a more and more important feature for consumers who want to have access to everything at all times. So I think in terms of behavior, we're going to see a lot less real estate holdings be more valuable to these banks as their digital solutions. But despite whether you're interacting with the consumer online or in person, staying in touch with that customer is a must. BNP Paribas actually introduced a new client experience program that introduced digital services such as secure chat and video conferencing, as well as digital vaults for you to feel like your documents are being protected with the requisite security necessary to conduct these kinds of transactions digitally. Unlike prior periods of market volatility, though, COVID-19 prevents customers who are seeking reassurance and guidance from meeting their financial advisors at a branch or their house. So right now, these solutions are more important than ever to make sure that those relationships are maintained and grown over time. With new communication solutions being rolled out by these respective financial services companies, though, it's becoming increasingly important that each consumer feel like their needs are being met at a personalized level. 80% of consumers actually report that real-time personalized guidance is very or extremely important to them as it pertains to their financial banking situation. So we're not just seeing that this real-time targeting and addressable dynamic content spilling over into the media ecosystem, but that one-to-one level of customization is becoming more and more important to financial services as well. And while that level of customization is incredibly important to the consumer, right now, as of 2019, only 94% of those financial institutions report not being able to personalize their service to the levels that the customers desire. And Robinhood's outage shows the importance of reliability and trust. Ultimately, reliability can make or break fintechs. Customers couldn't access their Robinhood accounts and sell out their positions during a market drop, which potentially exposed investors to significant losses. And I know Robinhood has since retroactively gone back and offered compensation for those outages, but there is no value that you could put on the lack of trust or the dissipation of trust that happens as a result of those kinds of outages. So while Robinhood, from an investment perspective, might see a downturn in the activity on their platform as their recent outage, some of the more stable financial institutions like a Schwab were able to endure the kind of situation that we saw unfold over the last month successfully, and as a result, in turn, have raised their brand favorability and customer trust levels. Part of maintaining that level of trust, though, is helping your customers develop a route to financial health. Before the current coronavirus pandemic, only 30% of Americans actually said they would consider themselves financially healthy. So as we think about the implications of this long term and creating these environments where customers feel nurtured and taken care of and have their needs met at a personal level, this is a step that financial institutions need to be taking in order to safeguard and protect their customers' finances for the future and make them feel like they have their best interest in mind. There is some caution for financial advisors and general consumers alike, though. There should be a surge, unsurprisingly, in fraud-related coronavirus activity. So investors and general consumers alike should watch out for investments connected to the threat of COVID, such as miracle cures being developed, funds being raised for the production of ventilators or masks. There are a number of scams that are being enacted right now. So this is kind of part of the overall education process and keeping that close connection with your consumer that we've been talking and alluding to throughout this entire section. This is just another way that you can kind of differentiate yourself from the competition as it stands from a brand trust perspective. And just to kind of end this section on a hint of optimism, that despite the uncertainty that may come with the other side of the coronavirus pandemic, since 1900, the stock market has had 32 bear markets, but at one point or another, it has come back no matter what. So whatever is on the other side of this, with the stock market is ultimately going to be 33-0 at some point. So I'll just pause there, make sure that we are okay to keep cruising along.
Yeah, there is one question. Do you
Sure.
have any thoughts on how long a recovery might take to begin?
I mean, I think it ultimately depends on a couple of factors. One, when are we returning to what this new normal is? Obviously, the longer that this drags on, the more serious the implications are going to be long term. So I think that once the shelter in place restrictions are going to be lifted, we'll have a better idea of how we're going to pan out economically in the long term future. But if I had to take my best guess in terms of how people are best prepared to pursue their financial health goals, this is looking like it's going to be more of a 1 to 1.5 year recovery process in terms of the data I've been able to glean insight from.
Cool. That's it for now.
Awesome. So lastly, as it pertains to personal finances, obviously there is going to be some impact from an insurance perspective, whether that be health insurance or the decreased driving rates in auto insurance or people's ability to file homeowners insurance claims. There is a slew of options across the insurance sector that are ultimately going to be impacting people at a personal financial level. Most pressing, unsurprisingly, are the issues facing the insurance sector in healthcare specifically. The Economic Policy Institute estimates that 3.5 million workers likely lost their employee-sponsored health plans over the past 2 weeks, which represents 1/3 of those having filed for unemployment during this period. So that's a pretty significant takeaway considering the amount of Americans who need to go out and get tested and ultimately get treatment for the coronavirus at this time, is that so many more people are left uninsured as a result of the financial turmoil undergone by businesses, and they're going to be incurring significantly higher costs than if they were insured ultimately. But thankfully, health insurance providers are taking steps to help those experiencing hardship as a result of COVID. 3 major health insurance providers have now pledged to shield patients from high medical bills if they do need treatment from COVID, and that's Aetna, Cigna, and Humana. But beyond the pressing health implications, consumers across the country are wondering if they'll be able to meet payment deadlines or face cancellations to their various policies, leading to call center volumes going through the roofs like never before. With call centers inundated, though, Insurers' digital capabilities, similarly to those that are being challenged right now in the financial services industry, are under scrutiny as consumers pivot to online solutions to satisfy their needs. Insurers who nimbly adapted to digital-first service models are probably best positioned to handle this influx of business currently, but it's imperative that insurers continue to develop additional functionalities such as alerts and messaging, as front to data management and chatbots, in order to remain a leader in the space in the new normal. And as a result of this, some consumers inevitably have grown frustrated with their current providers and the services and the payments that are being provided back to them, which is leading to higher consideration and insurance quote shopping around. And COVID is probably having an impact on the insurance sector most positively in the financial space, as auto policy holders or as auto insurers should be receiving up to $50 per policy holder as a reduction in this driving ecosystem. But that money is ultimately going back into the pocket of the consumer, as a lot of those insurance companies have pledged to give the money back. Insurers, Encompass, Allstate, and Nationwide all pledged to give at least $50 back to policyholders for each of the policies that they hold next payment cycle. This has led to consumers exploring alternative insurance options that allow a little bit more flexibility and give them a little bit more bang for their buck, though. Pay per mile insurance could be a great option for those who don't drive as much long term or are looking for a solution that more meets their needs in this current environment. Some companies like Metromile actually specialize in this, but bigger companies like Nationwide offer programs like Smart Miles that allow you to pay as you go, if you will, based on the mileage that you drive. In the housing insurance sector, beyond the financial implications of people having to delay payments and not being able to collect claims, there is going to be a significant disconnect in terms of people actually going out to houses to make these inspections on claims. So they are developing digital solutions that allows people to go into others' homes with their camera and take videos in order to file claims more seamlessly. For the renters market specifically, we're seeing a lot of this process being handled digitally, as people are just being encouraged to submit photos to the app in order to make the claims process kind of go a lot quicker. And as it pertains to the consumer, many states have ordered those auto and homeowners insurance companies to provide flexibility to customers who are financially affected as a result of this crisis. At the more micro level, beyond the impact of the upper echelons of these insurance providers, independent agents face massive disruptions to their business practices during this time. Two great examples we've seen of companies who are actually giving back in order to help these smaller businesses mitigate the effects of the current climate. One is Travelers, who is expediting the payment and distribution of their commission checks in order to give more money back to their agents, as well as Progressive, who is developing a couple of comprehensive solutions that the independent agents can roll out in order to service their customers on a digital platform. So this is a phrase that you keep hearing get thrown around by the lab, and I'm sure across a lot of other media. As we move into this next normal, I think there are a couple of key takeaways that we can be thinking about as it pertains to both personal finances and financial implications on business, the insurance sector, and the financial services realm. Number one is secure digital solutions. I think at this time, giving accessibility to the consumer and making sure that there is no disruption in their normal day-to-day activity is the most important thing a brand can do at the moment. So making sure that you have built the most robust, comprehensive online solution to help your customers manage whatever they need is incredibly important. Contactless payment. As I stated before, 38% of consumers actually think that's table stakes now, but that number is sure to rise as we move into a post-COVID world. I think we're going to see a lot of people hesitate to interact with everything in this store, especially point of sales terminals that everyone is swapping their money through and their cards through. So contactless payment is definitely going to become more prominent on the other side of this. Enhanced personalization is something that we are all familiar with, obviously, as media people, but I think that enhanced personalization in terms of creating products that are unique to each individual is going to be a key differentiator for both these financial services and insurers going forward. So as we build towards long-term recovery from a personal perspective, we are going to see a higher level of customization come through. Brand trust is something that we alluded to at the top of this deck as one of the brand macro trends that we identified as part of COVID-19. And I think that it's going to be more prevalent than ever once we get to the other side of this. As we said, sites like Did They Help are keeping running tabs of what brands are doing to give back to the consumer at this moment. And the ones that are positioning themselves as part of the solution and giving back to the consumer are ultimately going to be the ones who succeed in the post-COVID world. New communication channels are incredibly important in terms of maintaining those personal relationships. I mean, we all know it from sitting on video calls like this every day. It's incredibly important to maintain that one-to-one, especially when we feel that lacking for that intimate conversation that we get to have in real life environments. So it's important for financial services and insurance institutions alike to develop new ways to stay in touch with people that meet all generations and not just appeal to one demographic. And lastly, as a result of this, I think we're going to see increased brand consideration. As I mentioned before, brand trust is going to play a huge role in that. But I think that as digital acceleration happens as a result of COVID-19 and we see more comprehensive solutions developed because of it, a lot of consumers are going to ultimately pivot away from the brands they are familiar with and opt for ones that are developing solutions that are more in tune with the times and also have a future forward perspective. And that is it. So I want to thank you guys all for sitting and listening, and I will pause there and see if there's any other questions that have come through.
No additional questions yet, but we're a little ahead of schedule, so we can hang out and wait for a couple seconds to see if there's any follow-up.
Yeah, of course.
All right, I think that that's a wrap.
Great. Well, thank you everyone for joining. Obviously, if there's any follow-up questions or if you want to pick my brain about any of the content that you saw here further, reach out to me anytime. Our emails are there at the bottom, but feel free to contact me via whatever medium is easiest. And thanks again for listening in.